I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm, considering a recession in the US or globally. The amount of printing that would have to be done to get us out of that would be massive, and gold would be the main recipient. That's right. I agree 100% with you. So I do see silver potentially at $100 in a few years. It's just a matter of you got to flush out the weak hands. And this goes for gold. A lot of people get very upset when you're talking about any asset that they're long pulling back. But there was a point where you saw that parabolic move in gold and silver. And that's where you start to get people that are thinking, oh, this is the easy investment, right? And for those of us that have been long-term gold holders, there's no such thing as easy in gold, right? Or silver. So, those people have to be flushed out, get the weak hands out, get it back to its hardcore level, and it'll start grinding higher again and make new all-time highs.
Gareth Soloway outlines a compelling long-term outlook for both gold and silver, suggesting that multi-year targets of $10,000 for gold and $100 for silver are within reach. He emphasizes that these levels are not speculative extremes, but a natural consequence of massive monetary stimulus required to navigate potential U.S. or global recessions. Soloway highlights the importance of market flushes, where short-term corrections remove weak hands and speculative traders who mistake gold and silver for easy gains. These temporary pullbacks, while unsettling to newer investors, strengthen the market by consolidating ownership among committed, long-term holders. Once these corrections run their course, the metals are poised to resume their upward trajectory, establishing new all-time highs. Patience and resilience, he stresses, remain key for investors navigating this generational bull market in precious metals. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Gold is usually a safe haven asset. So when things get bad, people want to buy gold. But the problem is people have been buying gold and it's a larger part of their portfolio. And so when we see the stock market decline sharply or the crypto markets decline sharply, there will be some margin calls in those groups, which will then cause people to have to sell some of their gold to cover those margin calls. And I think, again, this is where leverage comes in. People have gotten way over leveraged in the stock market. In fact, I was looking at margin numbers. People are borrowing more money than they've ever borrowed before to invest in the stock market. That's great when it just goes up, but when it corrects, that creates margin calls, and that money has to be found somewhere. And again, I think this is where the case for a pullback in gold comes in. And so you can see on the chart here, this was my first target on this pullback here at 39.48. We obviously hit it. We bounced. Now we're starting to break lower. My next target is 38.45. After that, we're looking at 36.95. And the big level where I will be accumulating in a major way is this max drawdown level at 34.85. At that point, we're almost back $1,000 lower on gold. Now, a lot of people will be hearing this and saying, oh, it's never going to go there. I want to show you guys something that's really, really cool here. It's far different than the 1980s. In the way it is. And I think that's why the base case for me is this is a pullback where we should see new all-time highs in 2026. So yes, it's going to be a pullback where it could come back as much as, another, we're trading around 3,900 and change. So we could come back another $400, $500. But at that point, I think you have to buy it because you're right. What's the alternative? Are you going to go into treasuries when they're cutting rates? So you're going to get a minimal return on those. 4%, 3%, whatever it's going to be, especially when fiat's getting printed like crazy by the Federal Reserve. Debt to GDP, like you mentioned, I think those are other factors where central banks are telling us what to do. They're all buying gold, right? And so while gold is reacting emotionally, so you're getting this sell-off and you'll probably have the margin calls causing more selling pressure, people taking a little bit off the table for profits, inevitably the trajectory should be much, much higher. And I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm, considering a recession in the US or globally. The amount of printing that would have to be done to get us out of that would be massive, and gold would be the main recipient. Bitcoin to some extent, I think as well, but that's more of a risk on, risk off asset, right? That's right. I agree 100% with you. So I do see silver potentially at $100 in a few years. It's just a matter of you got to flush out the weak hands. And this goes for gold. A lot of people get very upset when you're talking about any asset that they're long, pulling back. But there was a point where you saw that parabolic move in gold and silver. And that's where you start to get people that are thinking, oh, this is the easy investment, right? And for those of us that have been long-term gold holders, there's no such thing as easy in gold, right? Or silver. So, those people have to be flushed out, get the weak hands out, get it back to its hardcore level, and it'll start grinding higher again and make new all-time highs. Yeah, so silver, and this is, by the way, this is just a remarkable chart as well on silver. So a lot of people were thinking silver would rip higher way past this 55-ish level. But look at this chart. This is a parallel. So parallel meaning that this bottom line is perfectly parallel to this top line. This is your low in 2008, so your financial crisis low. This is your low in COVID. If you take that line, right? So let's just go back to that and say, all right, here we draw this up and we bring this to the high of the bull market in 2011. It gave us precisely our high in 2025. Now, just like with gold, I think that, you're going to get a pullback here, especially with an pseudo-industrial metal like silver. But I would start looking to buy once we get back to about the $43 level. All right, you have a level here and you have an upsloping trend line in this range here. But these are both levels where I would start to really heavily accumulate. Basically, once we get below 43, I'm buying all the way down as far as it wants to go for that next leg up. Because I still think, again, yes, it's industrial, but it's still a metal, right? So it has to be denominated in terms of dollars. And if dollars are depreciating, by default, silver should go up.
Gareth Soloway explains that margin calls and leverage in the stock and cryptocurrency markets primarily drive recent pullbacks in gold and silver. While gold has retraced to key support levels around $3,900, further declines could bring it down toward $3,485, presenting strong accumulation opportunities. He stresses that these temporary dips are healthy for the market as they flush out weak hands and set the stage for new all-time highs. Soloway remains confident in multi-year targets of $10,000 for gold and $100 for silver, citing potential recessions and massive monetary stimulus as key drivers. For silver, he identifies $43 as a critical accumulation level, noting its industrial use but emphasizing that its value will rise with dollar depreciation. These dynamics suggest that both metals are poised for substantial gains as long-term bullish trends continue. Let's get into the interview.
Let's take a look at gold. We'll split the screen up here, and I want to show you guys going back to the period here. Let's go all the way back on the weekly to 1979. All right, and this is one of the coolest things. This is how I actually basically called the top on gold. Back when we were getting to those high levels, as I looked at the chart, and I'm just going to clean this up a little bit here, but I looked at the chart of gold in 1979, and it was identical to the chart that we were currently forming. Now, you might say, well, how is that even possible? I mean, that was 45 years ago. But look at this. Look at how gold behaved going into this period. So you have this, essentially, you have in 1979, this beautiful move up. Then we had this consolidation phase. In 2025, we had the move up, the consolidation phase. Then literally in 1979, we had 9 months of upside in gold. So 9 consecutive months of up. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we had this big correction. Look at over here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And lo and behold, we're now correcting. And so we are mimicking the 1979 to 1980 top in gold. Now, I do want to make this clear is it is different this time. Yes, the pattern is repeating. In 1979 and 1980, Volcker was raising interest rates 18%, 15%. I mean, it was just incredible versus now the Fed is cutting rates. All right. Also, the GDP, debt to GDP was 30% back then. It's 130% now. And so for the thesis here is that while the pullback is going to be deeper than most people think, I actually think we hit new all-time highs in 2026. And so I think it's going to be much more shallow versus in the 1980s. We didn't actually hit new all-time highs, I think, for like 20 years on gold from that top in 1979, 1980. So I don't think the pullback will last as long. but I still think we'll retrace. And I just want to show one other thing here on this chart is that if we look at how deep the pullback was before we kind of got our first big bounce in gold, it basically went back to essentially that major pivot high right here where we consolidated, right? And so here you can see it pulled back right there. Okay. So the idea here is the same thing could be replicating where we pull back to about 3,500 and then we start our next leg to the upside. And so anyways, at least that's my view on it, is that I'm a big long-term bull on gold. I've been holding gold for years and years and years. It's great to feel like it's finally paying out. I'm sure many people feel like that, but it doesn't mean it's immune to pullbacks. We just have to be realistic about it and then buy those dips.
Gareth Soloway highlights how current gold price action mirrors the 1979 and 1980 bull market, showing a pattern of a strong move up followed by a consolidation phase. While history is repeating itself, he notes key differences. Back then, Volcker's Fed was aggressively hiking rates and debt to GDP was much lower, whereas today rates are being cut and debt levels are much higher. Soloway expects the pullback to be shallower than in the 1980s, potentially reaching around $3,500 before resuming its upward trajectory toward new all-time highs in 2026. He emphasizes the importance of buying dips during these corrections, framing them as opportunities rather than setbacks. For long-term investors, the underlying bull market remains intact, and disciplined accumulation during pullbacks is the key to maximizing gains as gold continues its multi-year bullish trend. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.